Trading in the Zone by Mark Douglas. In this channel, I talk about everything day trading from prop firms, risk management, trading strategies, and today is no different. Today I'll be talking about trading psychology and how to think in probabilities. In a career of a trader goes through fear, anger, frustration, confusion, and sometimes even to the extent of being overconfident. Mark also concludes that consistent winners execute their trades without emotions. These traders not only use technical and fundamental analysis to make decisions in the market, but also they have a third point of mental analysis. Today, I'm going to do a summary of important takeaways from Mark Douglas' book, Trading in the Zone. Every trader approaches trading with a positive expectation of making money. Otherwise, why would they even bother trading? No one wakes up consciously taking a trade and expecting to lose. Why would they even take a trade in the first place? But what happens when these strings of losses goes over and over again? Will a trader lose his mind? Well, let's find out. Coming into trading, let's look first at how a professional trader approaches trading. A professional trader embraces the fact that he will encounter both losing and winning streaks. But because he has a strategy that has an edge, he knows that over a large number of trades he will win on balance. He views losses as a necessary expense that comes along with running a business. Every trader is aware that there is an element of risk, but does every trader accept the risk? Or even, do they entertain the thought that the trade may lose them money? Mark Douglas called this a psychological gap. The gap between assuming that a trader accepts the risk to fully embracing the risk. The best traders in the world know that every trade is a random event. And being in a series of losing streaks does not deter them from executing their next trade. Similarly, a consecutive series of winners does not lead them to be complacent and mismanage their risk. The hardcore reality of trading is that every trade has a certain outcome and is independent of the past trade that has been taken. So, unless you learn to accept the possibility of uncertain outcome, it will be very hard for you to succeed as a trader. Mark Douglas provides 5 fundamental truths to help you embrace risk and uncertainty. Number 1, anything can happen. Number 2, you don't need to know what is going to happen next in the market to make money. Number 3, there is a random distribution between wins and losses for any given set of variables that define an edge. Number 4, an edge is nothing more than an indication of higher probability of one thing happening over the other. Number 5, every moment in the market is unique. Once the trader fully accepts and embraces these rules, they will be able to trade in the zone. A zone where Mark Douglas is saying is where you are not fearful of making money and not fearful of losing them. Now, let's look at gambler's fallacy. A fallacy is a belief that a statistically independent event is affected by previous sets of events. Suppose we do a series of coin tosses. Logically, we know the outcome is 50% heads and 50% tails. Suppose we toss 5 coins and turns out to be heads. Do you think the 6th coin is going to be head? Well, there is no change in probability. We expect the 6th toss to be either head or tail. So, how does this relate to trading? When a trader takes 5 losses in a row, he may conclude that his strategy is not working and maybe the market is rigged. Conversely, if the 5 turns out to be profitable, he will conclude that he has the best trading strategy and form unrealistic expectation about trading. In either case, whether it was 5 consecutive winners or 5 consecutive losses, the sample size is too small to make a judgment on the profitability of the system. The author stresses the importance of acceptance that each trade is completely random. This relates to the third fundamental truth, which says that there is a random distribution between wins and losses for every given age. According to McDouglas, trading in the zone means being in a carefree state of mind, a state where you are confident but not euphoric, a state of mind where you do not have fear or compulsion to do anything as you wait for the market to come to you. To help you develop this carefree state of mind when trading, McDouglas provides 7 principles of consistency. Rule number 1. Objectively define your age. Number 2. Predefine the risk of every trade. Number 3. Learn to completely accept the risk that is associated with every trade so that you'll not be surprised if the trade ends up negatively. Number 4. Execute your trade without reservation or hesitation. Number 5. Pay yourself as the market makes itself available to you. Number 6. Continually monitor your susceptibility to making errors and correcting any bad habits that are costing you money. Number 7. Accept the necessity of having these principles and never violate them. Mark explains that 95% of errors stem from your ability about being wrong, losing money, missing out, and leaving money on the table. He calls them the 4 primary fears. They counter your ability to trade with clear state of mind and preventing you from entering the zone. In summary, you want to pay attention to your state of mind when trading. Remember, anything can happen and every event in a market is unique. Therefore, it is important to approach trading with a probabilistic manner and embrace risk. You can't be certain about what will happen next in the market to get the direction. Hopefully, you find something to learn from this video. Please consider subscribing, share, and give a comment for what you want us to do in the next video.
दिल सोज से खाली है, निगह पाक नहीं है, फिर इसमें अजब क्या कि तू बेबाक नहीं है।